Roy. Of course, Ranjan, a stock split isn't supposed to change anything fundamentally, but meme traders have different ideas. You see this latest split as a way to capture that 2020 summer energy when Tesla did its split and the shares rose some 80% on the back of it. But it's not going to work this time?
Yeah, I will admit, in the summer of 2020, in August, I was very skeptical. There was a lot of chatter that a stock split's going to drive interest, juice the stock. I didn't believe it, and I was completely wrong. The stock shot up 81% that month after the announcement of the split of Tesla. And if we think back to that summer, August 2020, that's really when the foundations of these last 2 years of meme-ified exuberance kind of were taking place. Remember, that's when like Zoom was up 40% in a day. The word gamma squeeze started making it into the financial conversation. So I think we can kind of look at the Tesla 5-to-1 split as the first chapter in this whole saga. I think today's split is going to kind of be one of the last chapters because I think this era of meme stock craziness is over. I think investors know and understand that in reality, this is not going to change the financial health of the company at all. And it's just a last gasp effort at trying to juice the stock. And I think Tesla is going to trade in line with fundamentals and the market as a whole. And the split is going to be irrelevant.
Right, but Ranjan, it never really made sense in the first place. You attributed it to, I think you called it meme exuberance. Isn't that back in the markets? I mean, all we've been talking about over the last week is Bed Bath & Beyond. Look at what AMC was able to do with Ape shares.
Yeah, okay. AMC and Ape, trying to get into that is a whole other thing. But again, very quickly, AMC introduced a whole new tranche of preferred equity with the ticker APE, yes, APE, based on the meme, and basically created a 2-to-1 split. Bed Bath & Beyond, we know shares jumped almost 400%. Now they're back down almost to pre-meme levels, but it's up a little bit today on some financing news. But the main thing to realize is the compression of the life cycle of one of these memes. It's getting shorter and shorter. In the past, this stuff could go on for weeks or months. Now the up and down move happens very quickly, and that's because I think energy and capital are gone. Fed's hiking, there's no stimulus. People have been burnt badly already. So I really do think these are real last gasp efforts. And I would put AMC and the Ape new preferred equity ticker right alongside the Tesla stock split. They're trying the tricks of the past, and they're not going to work.
Ranjan, I want to throw you a curveball. I want to go back to D2C. We were just talking about Peloton. We're going to talk with Sasan Goodarzi of Intuit in just a bit about small and medium business. There's been this interesting thing happening, which I think we talked about in the past, where e-commerce trends are sort of normalizing to where they were before. And then at the same time, that online customer has gotten harder to target for multiple reasons. We see Peloton now going to Amazon, which could be kind of the embrace of death for, you know, a formerly at least D2C brand. How do you think this is likely to play out in difficult economic times to come? And what are the dangers for D2C brands that trade publicly?
Yeah, I mean, we've all seen the absolute slaughter in D2C stocks, Allbirds, Warby Parker, Rent the Runway, everyone down 70, 80, 90%. And honestly, I think Peloton going to Amazon, it's, as you said, it's kind of, you know, it's basically like giving Darth Vader a hug and embracing the Death Star. I mean, it's the idea that they're giving their customer data, that customers are going to buy a $1,400 bike for 2-day delivery versus actually having a direct connection with the brand and a direct emotional connection. And I, as a big Peloton fan, have that and understand that. I think this is all another example of e-commerce accelerated dramatically at the early part of the pandemic. Now it's essentially normalized. E-commerce is not, it's still well ahead of where it was in 2019. It's just the rate of growth is slowing because the last 2 years were so crazy. And I think trying to have planned on the back of those 2 years of growth and pretend that they would extrapolate out another year or 2 or 3 was the mistake of the Pelotons, of these other public company direct-to-consumer brands. And I think these moves that do feel a bit desperate, like Peloton going to Amazon, are real potential threats to their future, because I think they're giving away the direct connection with the consumer was always the true value. It was something that really was only enabled by the data, the online presence, the experiences you could create. So giving that away to a platform like Amazon, I think is a huge problem.
Well, investors, they like it, at least for now. Ranjan, I like that, like giving Darth Vader a hug. As always, thanks for your insights. We'll talk to you again soon. Ranjan Roy.